Okay, what we're looking at here is the dollar index is a monthly chart. And what I did was outlined a full year, January to January. And I want you to take a look at the price swings in between all of these reference points vertically. As you can see, there's a couple different market shifts that take place. And this is what it looks like if you have it set up on every 4 months versus the last slide being every 3 months. And I'll give you an example of seeing it again. This is your chart divided up on every 3 months and every 4 months, and you can still see it gives you a really good context of where the market structure is and what market shift should take place next. This is that same dollar index that's viewed on a weekly time frame, and we're looking at every 4 months for quarterly shifts, and we're going to drop down into a daily chart. You can see here we have the dollar index daily, and what I did was, again, I'm only using calendars of each month here from 1 January to the following year's January. I want you to take a look at how many times the market shifts back and forth and how many price swings that you see over the course of a full year. I want you to see how the market does in fact give us a very good macro view of the marketplace, where it gives us framework and structure to work within, so that way we can trade on one side of the marketplace and focus primarily there. All right, let's deal with a little bit more detail about what is a quarterly shift. Okay, on your chart, you're going to delineate with a vertical line on your calendar, and we're going to be viewing that as the anticipated quarterly shift. Now, we don't know that's going to be true, but we're going to do some things to arrive at how we can calibrate that level. And this is called the look back. What you're going to be doing is that you're going to look back from your month of study, wherever that is in time, regardless of when you start your analysis, the most recent past month, okay? You want to be using that first trading day of that month, put a vertical line on your chart, and then from that point on, you're going to be looking back to the left. You're going to be looking back to the left 60 trading days, 40 trading days, and 20 trading days. Now, why am I giving you those three parameters? The algorithm will reach back about 3 trading months worth of data. That's the average where it'll reach back for. Now, there's other times where it will go into further ranges, but for now, I'm just teaching you how to look for the most salient points of reference on the daily chart. The 60, the 40, and the 20 trading days left of the most recent calendar month, put your vertical line on that. That's your beginning marker point. And you're going to delineate what 60 days to the left of that is, what 40 days to the left of that is, and what 20 days. And they're all trading days, not calendar days. And you're going to basically, in those ranges, you're going to identify institutional order flow. What was the market doing 60 days ago to now, or to the vertical line of that most recent month that's delineated on your chart. Also, to the left of that vertical line you place on your chart, you're going to be looking back over the 60, the 40, and the 20 past trading days to the left of that past month, and you're going to look for recent institutional reference points. You're going to look for an old price high. You're going to look at an old price low. Why are you doing that? You're looking for a potential liquidity pool that would be resting above it, or if those highs have a lot of wicks, you're going to be looking for rejection blocks, which would be a move above the bodies of the candles for a potential sell-off, or below an old low that has long wicks on it. You'd be looking for the bodies of the candle to house some sell-side liquidity below that for a rejection block, or sell stops below an old low if there's not a whole lot of wicks to the lows that would be defined in the last 60 to 40 to 20 trading days. You're going to be looking for bearish order blocks, bullish order blocks in the last 60 days, and you're going to look specifically around the last 60, around 40, and the last 20 days. Basically, you're looking back the last 3 trading months. And you're going to be looking for fair value gaps and any liquidity voids as well. Once you identify over the last 60 trading days, okay, you're using the previous closed calendar month as your beginning reference point. Again, as an example, right now, today, it's January 6th, 2017. And if I were to use this method, I would look at December 1st, 2016. My vertical line would be on that calendar day. And then I would look 60 trading days to the left of that on my chart. I would look 40 trading days to the left of that. And I would look 20 trading days to the left of that, December 1st, or whatever the first trading day would be for December 2016. And I'd be looking for, over those 3 months, where's the high and where's the low. If the market has been trading higher, I'm going to frame everything off of the market low. If it's been trading lower, I'm going to frame everything off of the market high. Once you do that, what you're doing is you're anchoring your vertical line to a previous market structure shift. Okay, so let's go back to our daily chart of the dollar index. Okay, and this is what we had earlier in the presentation. I had January 1st, 2016 to January 1st, 2017. Okay, and I'm going to do what I just explained to you. If we were looking at the market in January 1st of 2016, we're going to actually do what I explained, and this is what we would end up at. We would be moving to December 2015, the first trading day there, versus January 1st of 2016. So we moved to the left and we noted that high. And we are using the first calendar day of the month. And then we're always using that reference point to calibrate and begin. So now we know how we can calibrate just like the algorithm will. We'll define it in the sense of every 3 months there is a shift. Also in the last 3 months, where is the liquidity at? Over the last 60 trading days, what we saw is the market traded higher from around October 2015, so it made an intermediate term low. The market traded up and created that short term or intermediate term high at December 1st or thereabouts. In the last 40 trading days to the left of that December 1st, 2015 delineation of that vertical line, we also see there was a consolidation and then expanded again once more time higher. In the last 20 trading days to the left of that vertical line, the market just kept pressing higher. Institutional order flow was bullish. So where is the liquidity at? It's going to be below the marketplace because the market has already traded higher. That's this reference point here, right below that October low. The market trades lower after or to the right of December 1st, 2015. Once the market trades lower, in between this reference point, once we identified where the market structure starts to break down, that means a key low was broken, and that key low is seen right here. Any retracement higher or movement higher at this moment, we're going to be anticipating a move lower because the market has already been moving bullishly. We've seen a market structure break lower, and now we're going to be anticipating a potential move lower in the dollar index. It could be a consolidation sideways, but we're still expecting a measure of bearishness in the dollar index post December 2015. The 60, the 40, and the 20, when we look back like this, again, we're focusing primarily on where has the market traded from. What was the institutional order flow at that point? And at this time, we can see clearly between the October and November into December 2015, the market had been trading bullishly. So by using this higher time frame daily chart, when we see the market structure shift bearishly, we're expecting now the next 3 months to be a potential correction. So using this last 60, 40, and 20 idea, we want to look at how price in those ranges, what has it created? Well, the market has moved higher. So prior to December 1st, 2015, the marketplace had an institutional order flow that was moving bullishly. So that means as the market was moving higher, every short-term low is going to have sell-side liquidity or sell stops below that. So in each one of these ranges, what we can do is define the range, find the low, and then we can note that as where all of the sell-side liquidity is. Now, once you have your vertical line calibrated to the most recent market structure shift, and you've done the look back and you've defined all of the liquidity reference points on the 60, 40, and 20 last trading days to the left, and you identified institutional order flow and you referred to all the recent institutional reference points that we've identified in brief listing, now you're going to be doing the cast forward. Okay, the cast forward is when you look ahead with the same parameters we used when we looked back. We're anticipating the next market shift in 20 to 60 trading days. We cast forward 20 days to the right of our vertical line when the last shift was 40 days ago. We cast forward 40 days when the last shift was 20 days ago. We do this until we reach the extreme of the projected 3-month limit. In other words, where there would be another vertical line drawn on our chart or capping 3 months. So what does that look like? This is what it looks like here. This is called the cast forward, where we have delineated a calendar first trading day at 2015, December 1st, as we did moments ago. We have a 20-day range, a 40-day range, and a 60-day range added to the right of our December 1st, 2015 delineation or the vertical line. And now what we have is a future day range or a data range. The algorithm is going to anticipate doing a shift in the marketplace in that range between 60 and 20 days. If we've seen the market structure break down, as we saw moments ago by delineating this low here, then we're looking for a market move going lower to fill in a potential liquidity void seen here. In the range of 60 days to the right of our market structure shift delineation that we have at December 1st, 2015, we expect a setup on the daily chart essentially in the next 60 days. So that tells you a time horizon. You could have to wait sometimes as long as 60 trading days. But it doesn't have to require you trading for that entire duration. You can use this to get daily bias context, you can get short-term setups, and you can get long-term objectives where the market should be moving over weeks and months versus limiting your scope on a short-term intraday basis and marrying those lower time frames. Now we're looking at the euro dollar in the same way, but obviously, like we mentioned earlier, the US dollar is going to be inversely related to the euro dollar. If we're expecting bearishness on the dollar index, we would be expecting bullishness on the euro dollar. So in the same way, we're going to add 20 days to the right of our 2015 December 1st, 40 days to the right of that vertical line, and then we're going to add 60 days to the right. I want you to see that the high formed here on the euro dollar, look how it falls directly right at the 60-day IPDA data range. Nails it on the very high. The algorithm will seek to do something in the first 20 days, the first 40 days, and up to 60 days after the most recent market structure shift. We saw a high form on the dollar index and expected the market to move lower because it broke its market structure bearishly. We can see the euro dollar made a low here December 1st, 2015, and price moved higher, breaking market structure bullishly for it. In between the vertical lines, okay, once you have calibrated your market structure on a quarterly basis, if we see that we're expecting bullishness on the part of the euro dollar because the dollar index was expected to go bearishly, that means all the way up into March 2016, we have a stance that the bearishness in the dollar should bode well for bullishness on the euro dollar. So between those two reference points, because we understand that December 1st, okay, we go out forward 3 to 4 months. We go as far as March 1st, and by having March 1st defined as the beginning of the new month out that far away, we project that limit on the quarterly range. In between December 1st and March 1st, we would be expecting a bullish signal to form in the euro dollar and a bearish signal to form in the dollar index. Getting back to what we mentioned earlier about buy programs and sell programs, the scenario would be, even looking at a daily chart, there's going to be a manipulation that takes place even on a higher time frame daily. Let's go back to the dollar index. Do you see the highs here? All these highs are forming inside of the data range of 60 days to the right of the beginning of December 2015. So all of these highs in here, higher, 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 is seeing what? After the market structure break below this low here, all these retracements higher, all that did was close in this liquidity void. When this void closed in up here, inside of the data range of 60 days, we have to measure, is there all this justified by using a inversely related currency like the euro dollar? Now we can go and take a look at the lows that were forming in the euro dollar. Here's 20 days, 40 days, and 60 days to the right of the delineation, setting our new marker for the quarterly shift. Look at the lows here in the euro dollar, all the way up to the 60-day data range. The lows were higher in the euro dollar. So this was under what? Accumulation. The underlying is failing to make a lower low. Again, at the same time that the benchmark is making higher highs. By all standards, this looks like bullishness every time a new high is formed, and it looks like it's trying to go higher. All it's doing is inching up to close in this liquidity void, that reference point that we talked about at the beginning of this teaching. This is what it's looking to close in. It's pressing higher. At the same time, all this higher high business is not being seen with lower lows in the euro dollar. and it's occurring in between where we delineate the market structure shift here. We go out 3 months. That means there's going to be a move that takes place in the next 3 months. On the daily chart, we're looking for it to happen within 60 days of a new calendar month. If this data range will go out and project that long. The 60-day delineation nails the very high. So you have a buy in here, and it ends right here after closing in this void. You can see here at the lows, we had a market structure shift that was bullish on the dollar index. We had these highs in here taken out on the upside. So no highs were violated on the upside prior to this high here on the daily. So institutional order flow broke to bullishness here because of the shift in market structure. The market's trading lower here, okay? Now we have another divider, okay, at June 1st, 2016. So all you're doing is adding another vertical line. Once you have one, you go out in time, you add these individually, okay? Now you can calibrate them as you see fit based on what the market's doing, but I'm going to resist the temptation to calibrate it based on this market structure shift here, because you could do the same thing here. Once this market structure breaks bullishly here, you can go back to May 1st and use that as your delineation, and then start going 20 days, 40 days, 60 days to the right of it, okay? And then draw another vertical line every 3 months or so. But I want you to take a look at what this has done. We have a low here on the dollar index. We have a low here on the dollar index that's lower, and then we have another lower low on the dollar index after the market structure has broken to the bullish side. So once we have an interruption in the down move, okay? Notice also, it's been essentially 6 months of down movement on the dollar. That's about when you're going to see the shakeup that takes place. But for this movement here, I want you to take a look at the relationship of how the dollar makes these lower lows in here. Let's go back to the euro dollar at the same time. Let's see what was going on around June of 2016 in the euro. Well, we're not seeing that higher high that would be reasonably expected. As we saw lower lows in dollar, let's go back again. We have lower lows in the dollar. At the same time, we should be seeing higher highs in the euro dollar. It's not happening. We see a higher high here, but you have to look at every institutional reference point. We have an old high back here. Relatively, this is not higher. It's actually lower. This is a market that's heavily being distributed. This market run up here is just a run on buy side liquidity, taking the buy stops out on short players already, and then the market trades lower. In between the vertical lines that delineate the next market shift, okay, there's a quarterly shift that takes place every 3 or 4 months, and you can see that these smart money accumulation and distribution programs are very easy to see in price action, but you have to define it in such a way where you now look for it to occur. Also notice, and I'll leave this for your own personal study, how many days away to the right of this calendar start does this high form? I'll leave that for your personal study. I'll also counsel you to take a look at this day right here. This is the election, okay? Even on the day of the election, there is exactly out to 60 days to the right of here. 60 days on the MT4 platform nails the very, very high that gives us the sell-off. So initially it opened up, traded higher on the euro dollar, and then rejected and traded aggressively lower. This higher high, again, here's the old high. This higher high is not being seen with a lower low in the dollar index. So dollars being accumulated, the underlying strength is in dollar. You can't go lower. And the euro dollar only went higher to take out the buy stops. They're going to reject that as false strength, or it's a suspect rally, and the price moved lower. And again, in summary, all you're doing is you're looking for a obvious break and shift in the marketplace. Like this was one here. Okay, the market trades higher. And then if we were looking at the market in February, we could go back to January 1st and put our marker there, and then go out 20 days, 40 days, 60 days, and you'd get something here. Or go looking back and see where the liquidity is resting. You're looking back to find where the liquidity is, and you're looking forward or to the right of it to get the very next setup in terms of the data range. You're going to know how long it takes potentially before the next setup forms, and how far back you look for the liquidity reference points, for where the stops are on the above or below the lows, and where the liquidity voids and gaps are that you want to be referencing. Like for instance, say it was November 14th, 2016. What month would you calibrate your vertical line to start? If you said October 1st, 2016, you're accurate. You're correct. If you said anything other than that, you're wrong. Okay? You want to go back to the previous closed month. You want to go back one full calendar month where it traded from the first trading day to the last trading day and then created a new month. By doing that, you calibrate yourself. That way you'll be able to see what IPDA is doing reference-wise, and then you start walking forward from there. When you see an obvious change in trend, which we saw up here, we have a market structure break here bearishly for the euro. All this rallying up is just another attempt to do what we saw happening in the dollar back here. When it had a market structure break bearishly, it traded higher up to close in a void and then sold off. The same thing's just being seen here. Market structure break here, market comes up, take out buy side liquidity, and underlying weakness seen here. The heavy distribution, and the market goes lower as a result of it.